If oil prices spike overnight, your investments, your expenses, and even your job security can be affected without a single change in your own country. That's how interconnected the global economy really is. Before we go further, take a second to like this video and subscribe. Because the goal here isn't to react to headlines. It's to understand the mechanics behind them so you can think more clearly than most people. Now let's address the topic directly, but with precision. When people hear about potential conflict involving the US and Iran, the immediate reaction is extreme. Either nothing will happen or everything will collapse. Both of those views are incomplete. The global economy doesn't crash from a headline. It responds through systems, energy, trade, finance, and confidence. And unless you understand those systems, it's easy to misread what's actually happening. Start with this principle. Markets move on expectations, not just events. If there's even a perceived risk to something critical, like oil supply, markets begin adjusting immediately. Not because disruption has already occurred, but because participants are pricing in the possibility. This is why you'll often see volatility before anything concrete actually happens. Now here's where your perspective needs to shift. Instead of asking, will this event crash the economy? Ask, which parts of the system are most sensitive to this type of risk? That's a much more useful question. Because different sectors respond differently. Energy reacts one way. Financial markets react another. Supply chains react differently again. And once you start breaking it down like this, the situation becomes less about fear and more about structure. You begin to see not just the event, but the pathways through which it could influence outcomes. That's the level of thinking you want to operate on. Because the investors who stay grounded during uncertainty are not the ones who ignore risk. They're the ones who understand how it actually moves. The most immediate and measurable channel in any potential conflict involving Iran is energy, specifically oil. Iran's geographic position places it near one of the most critical choke points in global trade, the Strait of Hormuz. A large percentage of the world's oil supply moves through that narrow passage every day. That alone makes it highly sensitive to geopolitical tension. But here's where you need to be precise. It's not conflict itself that moves oil prices. It's the risk of disruption. If markets believe supply could be interrupted, even temporarily, prices tend to react quickly. Traders begin adjusting positions, companies hedge against future costs, and that expectation alone can push prices higher. Now think through the implications. Oil is not just another commodity. It's a foundational input for transportation, manufacturing, logistics, and energy production. When oil prices rise, costs ripple through the entire system. Airlines face higher fuel expenses. Shipping becomes more expensive. Manufacturing input costs increase. And eventually, some of those costs are passed on to consumers. This is how a localized risk can influence global inflation. But here's the nuance that separates surface-level understanding from real insight. Not every price spike leads to long-term economic damage. If supply continues to flow and tensions ease, prices can stabilize. Markets are forward-looking. They adjust as new information comes in. However, if disruption becomes sustained or uncertainty remains elevated, then higher energy costs can begin to affect broader economic behavior. Central banks may respond differently. Businesses may delay investment. Consumers may adjust spending. So the real question isn't whether oil prices move. They almost always do. The question is whether that movement is temporary noise or part of a longer structural shift. And that distinction is what determines whether the impact remains contained or begins to spread across the wider economy. Once energy begins to move, the next layer of impact shows up in financial markets. And this is where most people misread what's happening. When uncertainty rises, markets don't wait for confirmation. They reprice risk immediately. That means stocks, bonds, and currencies begin adjusting based on expectations, not outcomes. And if you're only watching price movements without understanding the cause, it can look chaotic. But there's structure behind it. Start with equities. If investors expect higher energy costs, potential supply chain disruptions, or tighter financial conditions, they begin adjusting their expectations for corporate earnings. That can lead to declines in stock prices, not because companies have failed, but because future projections are being revised. At the same time, capital doesn't just exit markets, it rotates. It often moves toward assets perceived as more stable or liquid during uncertain periods. This could include certain currencies, government bonds, or sectors that are less sensitive to economic disruption. Now here's the critical insight. A market decline during geopolitical tension is not the same as economic collapse. It's a repricing process. Markets are constantly trying to answer one question: what is this worth under new conditions? And when conditions change, even slightly, valuations adjust. Currencies add another layer. If global investors shift where they hold capital, exchange rates can move. A stronger currency can reduce import costs but affect exports. A weaker currency can do the opposite. These shifts influence inflation, trade balances, and capital flows. But again, scale and duration matter. Short-term volatility is normal. It reflects uncertainty. Long-term impact depends on whether those uncertainties become persistent enough to change how businesses operate and how capital is allocated. So instead of reacting to every market movement, focus on what's driving it. Because once you understand the driver, you can distinguish between temporary reactions and meaningful structural change. Now let's move beyond markets and into something more subtle, but just as important: global trade and supply chains. This is where the real-world economy starts to feel the pressure. Modern supply chains are not simple. A single product might involve raw materials from one country, manufacturing in another, and distribution through multiple regions before it reaches the end consumer. That complexity creates efficiency during stable periods. But it also creates vulnerability when uncertainty increases. If geopolitical tension rises in a strategically important region, it doesn't need to completely stop trade to have an impact. Even small disruptions, delays, increased insurance costs, rerouting of shipments can create friction. And friction increases costs. Shipping companies may charge more due to higher risk. Insurance premiums can rise. Delivery timelines can become less predictable. Businesses that rely on just-in-time inventory systems may need to adjust by holding more stock, which ties up capital. Now think about what that does across the economy. Costs increase gradually, not suddenly. Margins get tighter. Some companies absorb those costs, others pass them on to consumers. That's how localized uncertainty becomes broader economic pressure. But here's the nuance you need to keep in mind. The global economy is designed to adapt. Companies look for alternative routes, alternative suppliers, and ways to maintain continuity. Over time, supply chains adjust. So again, it's not about immediate breakdown. It's about the degree of disruption and how long it lasts. If tensions are short-lived, adjustments are minimal. If they persist, businesses may begin restructuring operations, which has longer-term implications for efficiency and cost. And that's where the impact becomes more structural. Because once supply chains shift, they don't always revert back quickly. They evolve. And that evolution changes how the global economy functions going forward. Now let's challenge the core assumption directly, because this is where most narratives go off track. Would a conflict automatically crash the global economy? No. And it's important you understand why. Global economies are not fragile in the way headlines sometimes suggest. They are complex, adaptive systems with multiple layers of resilience, diversified energy sources, strategic reserves, policy tools, and global coordination mechanisms. That doesn't mean there's no risk. It means the outcome depends on scale, duration, and escalation. If tensions remain contained, markets typically absorb the shock. You may see temporary volatility, higher energy prices, shifts in capital flows, cautious business sentiment. But over time, systems adjust. However, if disruption becomes prolonged or expands across multiple regions, the impact becomes more meaningful. This is where scenario thinking becomes useful. Instead of assuming one outcome, think in ranges. A limited disruption may influence prices and sentiment without significantly altering global growth. A more extended disruption could affect trade, inflation, and policy decisions more broadly. Now here's where your mindset matters. If you think in absolutes, you either ignore risk or overreact to it. If you think in probabilities, you stay grounded. And that's what experienced investors do. They don't ask, will this happen? They ask, if this happens, what changes? And how exposed am I? That's a much more practical framework, because it shifts your focus from prediction to preparation. And in uncertain environments, preparation consistently outperforms reaction. So where does this leave you as someone thinking about money, investing, and long-term stability? It leaves you in a position where clarity matters more than prediction. Because the biggest mistake most people make during geopolitical tension is not that they lack information, it's that they misinterpret it. They assume a single event will define the outcome. But in reality, outcomes are shaped by how multiple systems interact over time. Energy, markets, trade, policy, and confidence, all moving together, adjusting continuously. Now, from a practical standpoint, this leads to a different way of thinking about your financial decisions. Instead of trying to guess whether a specific event will escalate or fade, you focus on how different environments affect different types of assets. In periods of rising uncertainty, you often see increased volatility. That doesn't automatically mean long-term value is lost. It means expectations are adjusting. So the question becomes, are you positioned in a way that can handle that adjustment? That usually comes down to diversification, liquidity, and avoiding overexposure to a single outcome. Not because you expect the worst, but because you understand the system is dynamic. And here's the deeper insight. Financial resilience isn't built by avoiding uncertainty. It's built by understanding how systems behave within it. Because uncertainty is not an exception in markets, it's a constant feature. And once you accept that, your approach changes. You stop reacting emotionally to every headline. You start thinking structurally. You begin asking better questions, making more measured decisions, and positioning yourself in a way that doesn't depend on being perfectly right. And over time, that shift from reaction to understanding is what creates consistency, not just in markets, but in how you navigate complex situations in general.